Hi, this is Dr. Jessica Dunn, and today we're going to discuss stock valuation. More particularly, we're going to discuss the constant growth model, also known as the Gordon model. So to do this, we're going to need to discuss some different terminology. So first up, P naught with a hat. So P naught is the P with the little zero beside it, and then the hat is the triangle on top. So P naught with a hat, that is the stock's intrinsic value. The intrinsic value of a stock is the true value. It's what the stock is worth. P naught without the hat is the market price of the stock today. If markets are efficient, then the intrinsic value and the market price are the same. Sometimes they're not, but they should be very close to one another. D naught, that is the most recent dividend, where the zero represents time period zero. So it's the most recent dividend, and we always assume that it's already been paid. D sub T, where T represents time, that is the dividend at time period T. R sub S is the required rate of return, and R sub S with a hat is the expected rate of return. So a stock's value is, or well, the value of any asset for that matter, is the present value of the future benefits that you're going to receive from that. And so with a stock, the future benefits that you're going to receive are dividends. And you receive those dividends from the time you purchase that stock and forever if you hold it forever. If not, you hold it until you sell that stock. So the only cash flow that exists because of a stock is the dividends that you're going to receive from that. I know that some might say, well, what about capital gains? You receive capital gains once you sell the stock. You sell it for more than you paid for it. Well, at that point, the stock's price at that point is dependent upon the future benefits from that point on. So it's also equal to, at that point, it would be equal to all future dividends. So we can say, even if you plan on selling the stock at any point in the future, the value of that stock today is equal to the present value of all future dividends. And so we needed to discount those dividends. We need to discount them back to today's time to determine what that stock is worth. So we need to take the present value of dividend 1, 2, 3, all the way to infinity. Because the stock's value is equal to the present value of all future dividends. So some stocks, their dividends grow at a constant rate. They grow at roughly the same percentage rate year over year. There's been consistent track record of that. This is true specifically for large, well-established companies. They pay pretty consistent dividends, even if that dividend is zero growth. Well, whenever dividends are growing at a constant rate, if they have been and you expect that to continue into the future, we can use the constant growth model, which we can also call the Gordon model. And the constant growth model says that the value of the stock today is equal to the next dividend you would receive, so D1, the dividend in one period from now, divided by the required return minus that constant growth rate, where the dividend is growing at a constant rate forever. If we don't know D1, so if we don't know what the next dividend payable is going to be, then we can calculate that using the last dividend you received. So it'd be equal to D naught times 1 plus this growth rate. Now this growth rate is the only thing that you're going to have to approximate. And so lots of people will just look at the historic growth rate of dividends, and if the company hasn't done anything crazy, if they aren't expanding, if they aren't coming out with some new fancy product line that expect sales to go through the roof, they expect dividends to grow at the same rate in the future years. So that's often where the growth rate comes from, is from historic growth rates and dividends. And you can find historic dividends on lots of websites like Yahoo Finance. They're going to have the historic dividends paid by a company. So let's work an example. Company X just paid a dividend of $1.15. Its stock has a required rate of return of 13.4%, and investors expect the dividend to grow at a constant 8%. What is the stock's intrinsic value? So because this stock has paid consistent dividends over time, and we expect it to grow at a constant rate of 8%, we can use the Gordon model, which says that the price today, the value of that stock today, is equal to the next dividend you would receive divided by the required return minus the growth rate. If you don't know the next dividend, then you can calculate that using the last dividend paid and multiply that by 1 plus the growth rate. So we have all the inputs for this. And so now it really comes down to interpreting the problem correctly. So analyzing the word problem and making sure that you get the components right. So company X just paid. The rule is that we always assume that D naught was the dividend that was last paid. So because it says this is just paid, that's past tense. So that means that this $1.15 is D naught because D naught's already happened. We always assume that D naught was the last dividend received. Okay, so we expect the required rate of return is 13.4%, so that's our R sub S. And it's going to grow at a constant 8%, so that's our growth rate. So the first step, because we have D naught and we need D1, we need to calculate D1. So D1 is equal to D naught times 1 plus the growth rate. So that is equal to $1.15 times 1 plus 8%. And that gets us $1.24. Okay, so now let's go to our problem and use the Gordon model. The value of this stock is equal to the next dividend we would receive, that $1.24. This is our hat. Divide that by the required return of 13.4% minus our growth rate of 8%. So when we work that out, we get $23. So the value of this stock today is $23. So the sum of the present value of future dividends is the stock's intrinsic value. It assumes that there are an infinite number of time periods, but most of the value is based on dividends during a finite period of time, because each additional dividend has a smaller impact on the price today. So all of these future dividends out in the real far future are going to have tiny, tiny impacts on today's stock price. 70% of the value is attributable to the first 25 years, 91% to the first 50 years. So those dividends 200 years from now, not really impacting today's share price all that much. So with this, we had said that using the Gordon model that we were going to discount by the required rate of return. We had said that the price of that stock today, the intrinsic value, is equal to the next dividend received divided by the required return minus the growth rate. But how do we get the required return? It's not just a made up number, because in every example so far, I've told you what the required rate of return is. We can use our security market line, which we talked about when we talked about the capital asset pricing model. We can use that security market line to calculate our required rate of return. And remember, the security market line says that the required rate of return is equal to the risk-free rate plus beta times the market return minus the risk-free rate. So let's go ahead and calculate this required rate of return. The risk-free rate here given to us is 7%. Now, if this wasn't given to you and you were trying to find the risk-free rate of return, you could use the yield on Treasury securities. Plus beta. Now remember, beta is the slope of the line of best fit when plotting your securities returns against the market. And beta was 1.2. Then we multiply that by the market return minus the risk-free rate. The market return given to you here is it's given to you as the market risk premium. Remember that the market return minus the risk-free rate is the market risk premium. We covered that a few lessons ago. And so here we don't have to know what the market return and the risk-free rate are because it's given to us here. We're told it's 5%. So if you were calculating this for yourself and you needed to know what the market return is, then you would need to look at a large portfolio, a large group of securities. So for that, you might approximate the market return as the S&P 500 or the S&P 1500. It's just an approximation. So that would help you to assess your market return. So 7% plus 1.2 times 5% gives us a 13% required rate of return. And that is what we use to discount our Gordon model. So let's look at an example. Let's calculate the value of a stock if we are given that the last dividend paid, our D naught, it's supposed to be a D with a little zero, was $2. Our required rate of return is 13% and our growth rate is 6%. So remember the Gordon model says that the value of this stock today is equal to the next dividend you'll receive divided by the required return minus the growth rate. Here we're given D naught. So we first have to calculate our next dividend. So D1, our next dividend, would be equal to the last dividend paid times 1 plus the growth rate. So that's $2 times 1 plus 6% to give us $2.12. Now let's plug that into our Gordon model, which says that our next dividend received is $2.12. Divide that by our required return of 13% minus our growth rate of 6%. So $2.12 divided by 7% is $30.29. So the value of this stock today is $30.29. So let's continue. What would be the expected value 1 year from now? So 1 year from now, D1 has already been paid. So let's see what happens to our stock price in 1 year from now. So in 1 year from now, the expected price 1 year from now would be equal to the next dividend you would receive, which would be D2 at this point, divided by the required return minus the growth rate. So we would need to calculate D2. We said $2.12 was our last dividend times 1 plus 6%. That gets us $2.25. So now we can plug that into our Gordon model. So the price in 1 year is equal to the dividend 2 periods from now divided by the required return, 13%, minus the growth rate of 6%. And that gets us $32.10. So this year right now we expect our price to be $30.29. In 1 year, we expect the stock price to be $32.10. So we expect the stock price to increase. The reason is that we're not paying 100% of our earnings out in the form of dividends. And so because we have some retained earnings, the stock price should increase with that reinvestment of earnings because shareholders are going to demand a minimum rate of return, and so the company can either do that through paying out dividends or reinvesting in the company and earning a greater return that way. So let's look at our dividend yield and our capital gains yield. So our dividend yield is the rate of return that we're earning on dividends. And so we would calculate that as the next dividend received divided by the price of that stock today. And so these are numbers we've already calculated. We've already said that the next dividend received is $2.12. And we've already calculated the value of the stock today, and it was $30.29. So when we divide this, we get a dividend yield of 7%. Our capital gains yield measures stock price appreciation. So we need to take the price next year, expected price next year, minus the price of that stock today and divide it by the price of the stock today. So it's measuring our anticipated return through stock price appreciation. And so next year we expect the stock to be at $32.10. Right now it's at $30.29, and we divide it for what we paid for it, $30.29. And that gives us a capital gains yield of 6%. Now, it is not a coincidence that the growth rate and the capital gains yield are the same. The capital gains yield and the growth rate will always be the same as long as the growth rate is constant. So as long as the growth rate is constant, this capital gains yield will always equal G. Once our growth rate changes and is variable, that is when we're going to see capital gains yields other than the growth rate. So our total year one return, our total return, which should be equal to our required return, the minimum rate of return we're willing to accept, that R sub S that we calculated using this security market line. Write that better. R sub S. So our total return is equal to our dividend yield plus our capital gains yield. So our dividend yield was 7%, and our capital gains yield is 6% for a total yield of 13%. So our required return should equal our total expected return, because that's the minimum rate of return we're willing to accept given a level of risk. So if we're solving for using the Gordon model, we said that the next dividend paid divided by the required return minus the growth rate. If we were to rearrange this equation, we could rearrange it to say that our expected return, our required return, is equal to the next dividend divided by the current price. This right here, dividend yield. That was the formula we just went through for dividend yield. Plus our growth rate, and we said that as long as growth rates are constant, that's our capital gains yield. So all the Gordon model is, the constant growth rate model is a reformulation of our total return. Same thing. The required return is equal to the dividend yield plus the capital gains yield. So the only way we're making money is through the dividends we're receiving and stock price appreciation. If our growth rate is 0, we can also use the Gordon model. So if our growth rate is 0, meaning that our dividend is a constant amount year over year, and we don't expect it to grow in the future, then we just plug in our growth rate as a 0. You could also imagine that this is a perpetuity. This is a definition of a perpetuity. We have an equal periodic cash flow that occurs forever. Definition of a perpetuity. And the present value of a perpetuity is equal to that cash flow, or that dividend in this instance, divided by some required return. So we covered this way back when. But you don't even have to remember that if you don't want to. You can just remember the Gordon model. The price today is equal to the next dividend you're going to receive divided by the required return minus the growth rate. The next dividend we're going to receive is $2 because that's the only dividend we're going to ever receive because we don't expect it to grow at all. Our required return is 13% and our growth rate is 0. So that's 2 divided by 13%. Looks a lot like this formula, right? So all we're doing is subbing in a 0 for G if it's a 0 growth dividend. So if we divide this out, we get $15.38 is the value of this stock today. So for a constant growth stock, we have some conditions that must hold. The dividend will grow forever at a constant rate. The stock price will also grow at this rate. The expected dividend yield will be constant. The capital gains yield is also constant, and it will be equal to the growth rate. And the expected total rate of return is equal to the dividend yield plus the expected growth rate. These conditions usually hold for large mature companies, so it's often pretty fair to assume that large mature companies are going to have constant growth rate in dividends.